Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Daniel Lam, your host for the podcast. To start, let me ask you a question. Have you got any items or belongings that you love so much that you would never consider throwing away? I certainly have. And there are toys I've had since I was a child, and now my baby is playing with them. In finance, many investors have been in love with growth stocks for years. This year, one of the FAQs that I'm getting from both external clients and internal colleagues is that when can I add to growth stocks? Yes, that's despite our CRO team being overweight energy for this year, as well as all the volatility associated with growth stocks, all because that style had worked wonders for investors over the last decade. But clearly, the macro composition now is very different. In the past decade, we had QE. Rates and volatility were low, with VIX, the equity market volatility index, flooring at 10%. Low rates is also very favorable for the valuation of growth companies. So now fast forward to the last 20 months. Rates were no longer suppressed by QE. VIX's floor is at 20, i.e. volatility has at least doubled. We no longer have a macro environment that is growth companies friendly. It favors companies with good quality, steady earnings, and high dividend yields. And then unfortunately, despite explaining all these to clients, we are still getting the question, when can I add to growth stocks? I guess this is the joy of being a strategist. So let me tackle this in the best way that I can. So first of all, you need a shift in the narrative, at least on a short-term basis, that inflation may be slowing down again, and the Fed may ease its pace of hiking. So two figures to watch here in the short term. The first one is the non-farm payroll on the 7th of October. Any weakness in wages or unemployment figures would lead to hopes that the Fed may entertain slowing down its pace of rate hikes in the future. And the second figure is, of course, the US CPI on the 13th of October. You also need to read the technicals. So on the long-term chart of US 10-year yield, 4 to 4.25% seems to be the next resistance area. Reading across equities, if S&P 500 were to be in the 3250 to 3500 area at that time, which is going to be a key supporting zone for the index, then the stars would be aligned for a short-term, I repeat, short-term, trade to buy high-quality growth stocks. So why do I emphasize short-term? Well, the inflation narrative is still very much dominating headlines, and buying growth stocks is very much a counter-trend trade. So if you do decide to add, do it in a controlled size, and be very risk-conscious in the levels you take profit and levels where you set your stop losses. That's all from me today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.